Hi, welcome to Crypto Made Easy. This tutorial is about technical analysis and how to do it correctly as a beginner. So, what is technical analysis? Technical analysis basically is the study of historical trading activity with a view to predict a future market behavior. So, in cryptocurrency or in technical analysis as it relates to cryptocurrency and other financial markets, it's basically a study of what has happened before so as to be able to predict what is going to happen. This is because there is a saying that history repeats itself. And so it is believed and it has been established over the years that the psychology of people, the things that trigger people to buy and sell has not changed. What causes people to buy? Greed and fear. Those two human emotions are always almost constant. And so a study of what has happened in the past with regards to the price of an asset can be able to tell what is likely to happen in the future or what is happening now so that you can make your buying or selling decisions based on those indicators. So that is what technical analysis is all about. Technical analysis can be used to manage risk. But apart from that, it can also be used to identify the market condition, that is to know the market structure, the current market structure. It can also be used to identify areas of value and then to know your entry trigger, to know when to enter the market and also when to exit the market. Technical analysis can also help you to know how to cut your losses and how when to take profit and by how much percentage you should be looking at in order to take profit. So let's open the trading platform and see how we can carry out some technical analysis using some examples here. There are various technical analysis indicators that are used when trying to study the price of an asset over the time. So let's say this is a US BTC USDT coin. Let's say I want to change that to Algo USDT, and then I'll have my chart here. Now, in technical analysis, there are various tools that I use, but I'm going to be covering some of the basics in this particular tutorial, and one of it is Candlestick Chart. Candlestick Chart is what you're seeing right here, and Candlestick Chart really is a very great tool to use because you can use it to identify the current market condition. Okay, so identifying the current market condition in this case helps you to know whether you are in an uptrend or in a downtrend, and the candlestick chart can help you to do that. So what is a candlestick chart? The candlestick chart basically is a graphical representation of the price of an asset over a defined period of time. So if you what I mean by this is that every candlestick that you see here represents a particular time frame. So in this particular example, this candlestick represents 1 day activity of Algo USDT. So I can change from 1 day to 4 hours, and then each candlestick will now represent a 4 hour period. Okay, so this candlestick represents 4 hours, and this particular one represents 4 hours, and so on. So you can change the time frame depending on what you want or what you're trying to study. But for the purpose of this particular tutorial, let's stick to the 1 day time frame. So that is it. And then in a candlestick, there are usually two main parts in a candlestick. There are usually two main parts. Right here is what we call the body, and then this part is called the wick. So we have the body and the wick. We have a wick to the downside and a wick to the upside. So the body, and there are usually four data points on a candlestick. There are usually 4 data points, and these 4 data points usually we have the high, which is represented by the highest point on the wick. So the high in this case is $2.08. Okay, and then down here is the low. So up here is the high, down here is the low. And then for this particular candlestick, this is a red candlestick, by the way. A red candlestick signifies a period where the price closed lower than it opened. Okay, so that means in this particular red candlestick, the open price here is here. That is, the market opened at this particular price, which is $2, and then the market closed around this particular point, $1.8. So the market closed lower than it opened, and that is why this candlestick is red. If we're using this particular candlestick, the open price is at this point 1.8, and then it closed around this range $2.05. So to that is basically the difference between a red candlestick and a green candlestick. A green candlestick, the price closed higher than it opened, but in a red candlestick, the price closed lower than it opened. So when you click on a candlestick, you should be able to see these 4 data points. Here you have the open for a red candlestick, the open, the close, the low, and the high. For a green candlestick, you have the close here, the high here, which is the highest point price got to within that time frame, and then here is the open, and right down here is the lowest part that the price got to. So a candlestick chart can help us to identify the trend. Okay, so if I try to expand the view, I'll be able to see a particular pattern. So a candlestick chart helps us to identify a if we are in an upward trend or a downward trend. So a candlestick chart can help us to identify the trend. And if you look at this chart, you'll be able to tell whether it is an upward trend or a downward trend. Basically, an upward trend is a trend where is a trading is a chart where you have highs and higher highs and lows and lower higher lows. Okay, so you have higher highs, and higher lows, and but in a downward trend, you have lower highs and lower lows. So from this, we can say that this is an example of an upward trend, because you see from this point, the price kept rising. We have highs and then higher highs and lows and lower lows. So if I try to zoom in a little bit, we will see we'll see sorry about my network. Okay, so if I want to zoom in on that a little now. Okay, so here this is a particular low, and then this is a higher low, and then this is another low, and this is another higher low, and this is a low, and this is a higher low. So it keeps going upwards, so that's an upward trend. And if we have a downward trend, let's take it that this particular portion here, i- if this particular portion here is a downward trend, then we're going to be having highs. We have highs and lower highs, and it keeps coming down that way. So that is how to identify a trend on using candlestick. be used to identify market situation to know whether we are in an upward trend or in a downward trend. So there are different variations of moving averages. There is simple moving average, there is exponential moving average. Basically, a moving average is simply a calculation using the closing price of the asset for a particular period of time, adding it together and then dividing by the number of days or the number of hours depending on the time period we're looking at. So we can easily use the moving average to identify a trend. So let's say we're using the moving average. You can just go to indicator, go over to moving average. So let's say we're using the exponential moving average and the moving average. So if we're using the exponential moving average, and they are both very similar, the only difference is the formula used in calculating it. Exponential moving average takes note of current changes in price as compared to moving average. So if you type in your moving average, you would want to open up and set it to the length that you want. So if, for example, we want to look at the 200-day moving average, 200-day moving average, and we can set it, and that will give us an idea of whether we are in an upward trend or a downward trend. Basically, if the price of the asset is above the 200-day moving average, then we know it is an upward trend. And if the price is below the 200 moving average, then it is a downward trend. You can also decide to change. You can decide not to use 200 days. You can decide to use 1 week, depending on what you want to achieve at that point in time. For example, if I want to trade on a 1 hour chart and I want to know whether within that 1 hour we are in a it is it's an upward trend or a downward trend within that particular hour, I can easily use the moving average to tell. And as I can see from here, in the last few hours, the price has been trading below the 200 moving average. So this can tell me what is likely to happen next. But if I change to the day, you will see that it will be trading above the 200 moving average. So a moving average can be used to also identify the market trend. Then another thing we want to look at is the how to identify area of value. Identifying area of value basically makes use of two basic tools we call support and resistance. These are the area of value basically is a region where there is significant trading activity. So the area where there is significant trading activity will usually tell us whether it is that area is acting as support or it is acting as resistance. So what is the support? The support is an area on the chart where buyers step in to push the price up. So the support is the area or areas on the chart where there is significant trading activity. Okay, so we can easily identify areas of support on this particular chart. For example, if you look at this point, we can draw a support line here because at this point the price was going low, and what happens, buyers come in, step in and push the price up to prevent the price from going lower than this point. This is to say that buyers believe that the price at this point is a fair price, and so they are willing to buy more of that particular asset. And when it gets to this point, sellers began to sell, and as sellers were selling, the price was coming down, and this place still acts as a support because it doesn't get to that point. Buyers step in again and begin to push the price of the asset up. So that is how to identify support on the chart. Okay, now let's talk about resistance. Resistance is an area of significant supply where sellers step in to push the price of the asset down. Okay, so we can identify resistance around this point here. Let's say at this point the price was going up, and then sellers felt that they've had enough gain, and they decide that it is best that they sell. And as they start selling, the price comes down, gets to the support, buyers push it up again, sellers began to sell, and all that. You see that that particular resistance still holds, the price has not broken that barrier. Okay, but we can also identify another area of resistance here, somewhere around here, because the price gets to that point and it reverses. Sellers step in to push the price down. So it continues like that, and we have this point. Sellers are not allowing the price to go beyond this particular point. It gets there, they push it down, buyers step in again, push it up, and that is how support and resistance basically works. So on this particular chart, we can predict that this, all things being equal, considering that this particular coin is in an upward trend, that the price of this asset will not get to this particular point, which is $1.53, that before it gets to this point, buyers will step in and do what, and push the price up again. So we can easily identify another area of support around here, because at this point buyers also stepping in to push the price of the asset up. So we can say that this point here is also another area of activity, and buyers are willing to buy either at this point or at this point to make sure that the price of the asset goes up. So from here we can conveniently predict that sellers are going to step in again and push the price of the asset up. So if you're looking at a possible entry position, then you could consider entering at this particular point. You can set an entry price here, or if you want to be very cautious, you can come down to this point and set an entry position. Okay, so that is basically how support and resistance work. One thing you need to take note of is that when support is broken, it acts as resistance. Most times when support is broken, it acts as resistance. It's not always, but most times that is what happens, and that is how to identify areas of activity on the chart. So that is it for support and resistance. Apart from identifying areas of support and identifying the market situation, technical analysis can also help you to know your entry trigger, to know when to enter the market. It is one thing to know where to enter, but it's another thing to know when to enter. So that is what the technical analysis can also help you to do, to know when to enter a market. And so in entering a market, we can also use candlestick pattern to know when to enter a particular market. Now, one major thing about candlestick pattern is that once there is a long wick down, when there is a long wick down at a long wick down, suggests that buyers are coming in and that the price of the asset is going to rise significantly. And so we see something like that here. There is a long wick here, and what happens? Buyers, it is an indication that buyers are willing to pay, are willing to buy that particular asset, and that is exactly what happened. Buyers stepped in, pushed the price all the way up. And also, when there is a long wick up, when there is a long wick up, it's also an indication that it could be an indication that sellers are winning the war and they intend to push the price down. Okay, so that is one way you can identify whether to enter a market or not. For example, at this point here, we have a long wick down. Like I said previously, it could be an indication that sellers are willing to buy, and if they buy at this point, then the price is going to go up. And that is how to identify when to enter a market. You should always enter a market when there is significant discount, when the price of the particular asset goes down. Okay, and from our previous, from what I showed previously, where I talked about support and resistance, you will notice that the price here is getting close to our support, which is an indication that the support is going to still act as a point where buyers will step in and push the price up again. So you can use that to identify when to enter a market. And apart from that, you can also use an indicator called relative strength index. This relative strength index can tell you whether a particular asset is overvalued or undervalued. Okay, so we can go to technical indicators here and search for relative strength index, and then we can put it on the chart, and it will show us here. Let me take this off first. So the relative strength index will show us whether that asset is overbought or underbought. That is, whether it is overvalued or undervalued. And from what we have here, we see that now relative strength usually ranges between 0 and 100, and the points between 30 and 70 are usually considered a fair price for that particular asset based on previous price action. Okay, so at any point in time that the price of that asset rises beyond the 70%, the 70% mark, then you are entering an overbought situation, and what is going to follow is going to be a drop in price. We can look at what that is exactly what happened here. The price, the market was, algo was overbought at this point. It got to 82, and then what followed with a down a drop in price, and the price dropped all the way to this point. So at this particular point, it is still a fair price. It is at 50.49, and we can easily say that it is not overbought and it is not underbought. So relative strength index can help you to know when to enter a market, and usually you should be targeting to buy when the asset is below the 30. At any point you see the asset below the 30 percent mark, you should be thinking of buying at that point, and if it is above the 70% mark, you should be selling. So that is the use of the relative strength index. Another major use of technical analysis is to know when to exit the market. Supposing that your analysis was wrong and you've made a wrong decision, at what point should you exit the market to minimize your loss? And if you are right, if your analysis was spot on, at what point should you take profit so that you don't end up losing part of the profit that you have already made when the price of the asset begins to come down. Okay, so with regards to knowing when to take to limit your loss, that is when to stop your loss when you find out that your analysis was wrong. How do you know at what particular point to set your stop loss? Because that is the basic use of stop loss, to prevent a situation whereby your trading decision being wrong should not allow make you to lose all or a lot of money. So identifying where to set your stop loss can be made easy when you make use of this indicator called average true range. So ATR can help you to know when to exit the market. So what is ATR? ATR basically measures the volatility of the market. It measures the largest possible move of an asset during a time period. So when you set the time period, you can easily tell what is the largest possible move of this particular asset, by how much can this asset move downwards, and by how much can it increase upwards. So what you want to do is to set your ATR, to set your stop loss, sorry, at one ATR below the area of value. If you are setting your stop loss, you should be setting it one ATR below the area of value. So let's say we have already identified this particular point as our support. Okay, so we identify that point as our support, and based on we're hoping that the sorry yes, okay, let's say we're using this particular point as our support, and we are hoping that this price will not break the support. Rather, it will either get to it and go back upwards, or it will not even get to it and it will go back upwards. So let's say this is our identified support, and we want to enter this trade here. So at what point should we set our stop loss? We should set our stop loss one ATR away from the support. Now the support here is at $1.6. That is at the support level. Okay, 1.6. And what is the value of the ATR here? The ATR here is telling us that the average true range of algo, that is by how much algo can change in a day, is okay. Let me set this to 1 day. Okay, so the amount that ATR can change in 1 day is 0.39. Okay, so we have identified that algo can change, can go the price can go down by 0.39 in 1 day, or the price can go up by 0.39 in 1 day. So what that means is that we are going to subtract 0.39, which is the ATR that we have identified from here. We will set our stop loss at a point that is 0.39 below the support line, and our support is at this point 1.64, right? Okay, these are support 1.61, 1.61. So we are going to subtract 0.39 from 1.6164, and that will give us our stop loss. So that if you're entering a market and supposing that you were wrong, the price going down to this particular point, or 0.39 below the support line, will take you out of the market to limit your loss. And if you are not willing to take this amount of loss, in a day, then you may consider not entering the market at that point in time. And that is how to use the ATR to know when to move out of the market. Now, why are you using one ATR as your one ATR below the support line as your stop loss? This is because the closer, if you set your stop loss very close to the support, it could easily take you out of the market, and then the price will go up again and you miss the chance of making money. So what you want to do is you don't want to set your stop loss very close to your position, entry price, and also you don't want to set it too far from your entry point so that you don't lose a lot of money. And that is how to use the ATR to know when to set, or where rather to set your stop. Another important tool you can use to know when to enter a market is the Fibonacci retracement tool. So you can easily add your Fibonacci retracement right from the trading view here. You can just come over to this point, scroll down, and you will see the Fibonacci retracement. So you want to set your Fibonacci retracement. You want to start drawing your Fibonacci retracement from the lowest swing low of a major move to the highest swing high of that particular move. So in this case, I would want to start drawing my Fibonacci retracement from this point up to the swing high. Okay, and then that is it. So basically, the Fibonacci retracement helps you to know where the areas of major activity is, and it can also help you to know where, at what point marketers, or sorry, at what point buyers are very likely to come into the market and start buying to push the price up again. And from this particular point, we can see that the 61.8% Fibonacci retracement is a very good point. So if we want to enter into this market here, we can just set our trade here and wait for the market to get to that point, and then from there it will go right up. So that is how to use the Fibonacci retracement. In a Sometimes you may want to use the 50% Fibonacci retracement, but for most part of the time, you would want to use the 61.8% Fibonacci retracement, because at that point you will have the price has moved significantly from the swing high down to that point. So it is very likely going upwards from there if if that market is in an uptrend. If it is in a downtrend, you would want to flip the Fibonacci retracement and start drawing from the swing high to the swing low. So that is how to use the Fibonacci retracement. And with that, we've come to the end of this particular tutorial on technical analysis. We'll be able to talk about what technical analysis is and how you can use it to identify the market trend, to identify areas of value, support and resistance, to know when to identify your trigger, to know when to enter the market and where to enter the market, and when to exit the market if you are wrong. Okay, so that is it about this particular tutorial. If you like this video, please kindly give it a thumbs up and kindly subscribe to my channel. This is your first time of coming to my channel. I'll see you in my next video.